1 minute we were enjoying another solid rally in US equities, and then bam, it all came crashing down with the Dow falling nearly 4%, the S&P 500 by more than 4.3%, and the NASDAQ 100 losing 5.5%. So what happened and what does it mean? Well, on Tuesday in the US, we saw the release of the latest inflation data, and it wasn't pretty. It's because governments around the world have been trying to rein in inflation in recent months that we've already seen significant interest rate rises. People were hoping the data this month would show that higher interest rates were starting to have an impact, with this being reflected in a softening of the inflation data. While the year-on-year change in the headline rate of inflation did actually drop slightly from 8.5% to 8.3%, the month-on-month data actually rose by 0.1% instead of falling, as most had expected. But the real shock was in the core inflation data, which excludes food and energy. The increase in core inflation month-on-month was actually twice as large as expected, being an increase of 0.6% instead of 0.3%. As a result, the year-on-year core inflation surged from 5.9% to 6.3%. Not surprisingly, investors immediately began to speculate what this ongoing inflation could mean in relation to the next interest rate hike from the Fed, which is expected on 21 September. The probability for a third hike of 75 basis points is now regarded as a near certainty, with some even speculating the Fed could go hard and hike by a whole percentage point. No doubt this will cause further stress in the equity markets over the near term, but even in a falling market, there are ways to trade successfully from the long side. Take a look at this video we recently made and see how you can take advantage of a falling market by trading inverse ETFs.